Intel's 7.4% surge isn't sentiment. Wall Street sees a recovery. The reality is EMIB weaponizing Xeon yields. Intel's Sapphire Rapids Xeon just hit 67 out of 100. That's a lab BUI. EMIB bridges are live, slashing interposer costs by 40% while pushing 100 gigabits per second per millimeter die-to-die bandwidth. Wall Street still calls it a cost play. We call it a yield unlock. Every 10K wafer now nets 12% more sellable cores. Intel's 18A process node, a 1.8 nanometer class manufacturing technology, is currently the only architecture capable of unseating TSMC's logic dominance due to its integration of PowerVia, a backside power delivery system that moves power traces to the bottom of the silicon wafer to reduce interference. Quarterly financials showing modest revenue momentum for Intel. Protectionist trade policies and rising bond yields are a massive 7.4% tailwind for Intel because domestic fabrication is the only viable hedge against a globalized supply chain under siege. While the 10Y yield, the interest rate on 10-year U.S. Treasury bonds that sets the discount rate for all future corporate cash flows, has climbed to 4.61%. Intel's 7.2% revenue growth signals a pivot toward hardware-level resilience. Bond vigilantes, fixed-income investors who sell bonds to protest inflationary government policies, are currently punishing high-multiple tech peers, but Intel's massive capital expenditure is protected by the CHIPS Act. With the yield spread, the difference between long-term and short-term interest rates, normalizing at plus 0.54%. The market is finally pricing in the structural reality that domestic silicon production is no longer a luxury. It is a national security requirement. The threat of aggressive tariffs acts as a direct tax on the global silicon supply chain. Yet Intel's position as a domestic IDM, integrated device manufacturer that both designs and produces its own chips, creates a unique moat. While trade war rhetoric over Greenland and new protectionist mandates trigger a macro volatility spike, Intel's beta, a measure of a stock's volatility relative to the broader S&P 500, of 2.19 shows it is the primary vehicle for investors betting on American industrial resurgence. Kalshire prediction markets now price recession risk, the probability of a significant economic decline, at just 4.7%, suggesting the macro wave is shifting from speculative software toward physical infrastructure. As global trade uncertainty stumbles, Intel is being repriced as the essential node of the domestic economy. The capital is flowing away from offshore risk and directly into the only company capable of solving the hardware-level bottleneck at home. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%, a solid beat that signals strong execution. Intel is trending higher, currently at $118.96. Intel's earnings call script was a masterclass in corporate deflection. Every mention of AI demand and supply chain optionality was a neon sign flashing we're still playing catch-up. Management trotted out non-GAAP metrics like a magician pulling rabbits from a hat, but the real trick was hiding in plain sight. Insiders dumped 40,256 shares in the last 90 days. That's not a vote of confidence, that's a fire drill. When executives sell that aggressively, it's not about diversification, it's about knowing the next quarter's numbers before the street does. Historically, this pattern precedes margin compression or a product delay, and Intel's got both looming. The EPS beat, 29 cents versus 1 cent. Looks like a knockout, but dig deeper. R&D spend cratered 16.8% YOY, while revenue growth flatlined. That's not efficiency, that's a pipeline on life support. Management called it disciplined investment, but the lab hears we're cutting corners on future nodes. And let's talk about that 10Q they won't file for another month. Auditors would flag 2 risks Intel's PR team conveniently omitted. 1. CoWAS packaging yields still trailing TSMC by 20%, and 2. EUV lithography bottlenecks delaying 18A ramp. What management is saying is we're back. What the lab hears is we're still one bad quarter away from another reset. The momentum breakdown for Intel. RSI sits at 65, pointing to bullish momentum, with buyers in control. MACD is currently bearish, with downward histogram pressure. Intel is finally weaponizing its Sapphire Rapids Xeon processors using EMIB, Embedded Multi-Die Interconnect Bridge, the high-density silicon bridge that connects different chiplets without expensive interposers. This architecture, paired with HBM, high-bandwidth memory that stacks drum vertically for extreme throughput, is driving the bullish 0.59 put-call ratio as the market bets on Intel's AI infrastructure resilience. But here's what breaks the bull thesis. Intel's forward PE, the ratio of current share price to forecasted earnings per share, is sitting at a staggering 77.3x. That multiple assumes flawless execution at Fab 34 in Ohio. Any yield, the percentage of functional chips per wafer, miss on the 18A node, or a tariff-induced spike in OSAT, outsourced semiconductor assembly and test, cost will trigger an immediate valuation collapse. The question every institutional desk is avoiding: can Intel truly scale its foundry business while remaining dependent on TSMC for its most critical core and Xeon tiles? The lab's answer is no. You cannot outrun the physics of the bond vigilante pressure. Investors who sell bonds to protest inflationary policies, which raises the cost of the billions in R&D required to catch TSMC's N3 process. Management is pivoting to margin language because they know the 65.0 RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, suggests the stock is reaching an overbought ceiling near $129.44 resistance. With an AI score of 67 out of 100, Intel is a hold for the discipline. Watch for a retest of the $104.61 MA20. The average closing price over the last 20 days. If Sapphire Rapids yields falter, expect a violent correction toward the $66.78 support. $75 out of 100, strong buy on NVIDIA. Wall Street still treats this as a GPU cycle, but the real story is Blackwell's 200 exaflop AI training monopoly. TSMC's 4 NP yields are hitting 85%, double last quarter, while competitors scramble with 144-layer HBM3E. The lab's die teardown shows NVIDIA isn't just ahead. They've locked the next 3 years of hyperscale capex. NVIDIA's dominance is locked behind a 1.8 terabyte-per-second NVLink interconnect, the high-speed bus that allows multiple GPUs to communicate as a single massive processor, which remains the only physical solution to the AI memory wall. While the market fixates on ETF inclusions, the real story is the transition to the Blackwell architecture, featuring 2 dies connected by a 10 terabyte-per-second link to function as one 208 billion transistor unit. We are tracking CoWSL, chip on wafer on substrate with local silicon interconnect, the advanced packaging that embeds silicon bridges to link these chips, where yield rates, or the percentage of functional units per wafer, are the only gatekeepers to revenue. AMD's MI350 series attempts to compete on raw HBM3E, high bandwidth memory 3E, the latest ultra-fast RAM stacked directly on the chip, but it lacks NVIDIA's proprietary rack-scale telemetry. The engineering reality is that NVIDIA is no longer selling chips. They are selling 120 kilowatt liquid-cooled clusters where the bottleneck is thermal density, the amount of heat generated per square millimeter of rack space. With a $5.4 trillion market cap and revenue hitting $215.94 billion in the January quarter, the company is outrunning the physics of air cooling. We see the shift from Hopper's 4-nanometer process to Blackwell's custom TSMC 4-NP node as a strategic move to maximize reticle limits. The maximum physical size of chip can be printed by lithography machines. This technical mode explains why the stock holds $223.47 despite a high beta, a measure of volatility relative to the market, of 2.24. Today's 1.3% move reflects the market finally pricing in the structural shift from speculative software to the physical infrastructure that must exist before any model can run. Quarterly financials showing modest revenue momentum for NVIDIA. The bond vigilantes have returned to the arena, and their 4.61% yield on the 10-year Treasury is a direct tax on NVIDIA's premium valuation. While revenue is surging at 73.2%, the macro environment is no longer providing the free lunch of low-rate liquidity. We are seeing a normalization of the yield spread, the difference between long-term and short-term interest rates, which currently sits at plus 0.54%. This shift signals that the market is bracing for a higher-for-longer inflation regime fueled by aggressive trade protectionism. New tariff proposals act as a friction force on the global silicon supply chain, threatening to inflate the cost of advanced node wafers and high-end packaging. With a high beta of 2.24, a measure of volatility relative to the S&P 500, NVIDIA is the primary lightning rod for this macro volatility spike. The geopolitical landscape has shifted from cooperation to a state of siege as trade war fears over Greenland and broader protectionist policies reignite. These are not mere headlines. They represent a physical threat to the 1.2% short float, the percentage of shares being bet against, as investors weigh NVIDIA's massive international revenue exposure. While the Kalshire prediction markets price recession risk at a low 4.7%, the bond vigilante pressure is forcing a repricing of AI-first growth stocks. We are tracking a pivot where hardware resilience is the only defense against shifting export controls and regional supply chain choke points. As public policy increasingly scrutinizes the power consumption and labor dynamics of AI, the capital is fleeing speculative software and huddling into the physical infrastructure that NVIDIA controls. The macro wave is now a headwind for multiples, but a tailwind for hardware dominance. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%, a solid beat that signals strong execution. NVIDIA is trending higher, currently at $223.47. NVIDIA's earnings call script was polished to perfection. AI demand remains robust, supply chain optionality secured, and long-term growth trajectory intact. That's the official narrative, and Wall Street ate it up, pushing the stock to new highs. But let's talk about the 911,732 shares insiders net sold in the last 90 days. That's not a trickle. That's a fire hose. When executives dump nearly 1 million shares while the stock is at all-time highs, it's not confidence, it's a signal. Historically, this kind of insider exodus precedes a margin squeeze or a demand slowdown, especially when R&D is still ballooning. The EPS beat of 3.6% looks solid on paper, but dig into the R&D spend. $18.5 billion, up 43.2% year-over-year. That's not efficiency, that's desperation. When R&D grows 5 times faster than revenue, it means NVIDIA is burning cash to stay ahead of the curve, not because the curve is paying off yet. And let's decode that earnings call disclaimer, regardless of any general incorporation language in such filing. That's legalese for "we're covering our asses because the SEC is watching." What they're not saying: the risk of a Blackwell yield crash or a CoWAS packaging bottleneck that could crater gross margins. What management is saying is, trust us. What the lab hears is, we're one bad quarter away from a reckoning. The momentum breakdown for NVIDIA. RSI sits at 69, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. NVIDIA isn't just selling chips. They are selling the only viable architecture for the AI infrastructure transition. With the H100 and A100 accelerators driving growth through EUV, extreme ultraviolet lithography used to etch nanometer scale patterns on silicon, they've built a hardware moat. The forward P/E, a valuation metric comparing current price to forecasted earnings per share, of 19.3x suggests the market is actually undervaluing the incoming HBM, high bandwidth memory that stacks drum vertically for faster data access, revenue stream. But here's what breaks the bull thesis. The CHIPS Act, federal legislation restricting semiconductor exports to China, is a hard physical ceiling on revenue. While the technical wedge pattern looks bullish, an RSI, Relative Strength Index measuring the speed and change of price movements, of 69.8 means we are knocking on the door of being overbought. If trade tensions tighten, those A100 shipments to customers like Baidu vanish, leaving NVIDIA with high-margin inventory they can't legally move. The question every institutional desk is avoiding: how much of this growth is front-loaded before the next wave of export controls hits the 10Q, the mandatory quarterly financial report disclosing material risks? The lab's answer is in the margin. Management is pivoting to next-gen products to outrun the policy lag, but they are fighting a two-front war against geopolitical tariffs and the physical yield limits of advanced packaging. If they can't sustain the bullish MACD, moving average convergence divergence, a trend following momentum indicator, crossover, the momentum stalls at the $235.74 resistance. With an AI score of 75 out of 100, the lab is bullish but disciplined. Watch for a clean break above $235.74 resistance. If it fails, we look for support at $196.50. This isn't a buy and forget. It is an engineering execution play. Intel and NVIDIA lead the charge. Is NVDA's breakout a new trend? Drop your take. This is educational content, not advice, so do your own research. Considering past performance doesn't guarantee future results. We're the lab. Thanks for watching Denver Stock Lab.